And welcome to our halftime report presentation. Thank you all for joining us tonight. We have a lot of people on the webinar, and we're delighted to see you all here today and unpack some vital information for everybody. So let's go ahead and dive on into it. As we always, I'll start with some formalities. Triumph Capital Management, we are a registered investment advisor, or RIA, registered with the SEC. Our home office is here in Denver, Colorado. This evening, I'll be making some forward-looking statements. Of course, forward-looking statements are no guarantees, and I'll also be showing you some historical information. But with the forward-looking information, I want to make sure that everybody understands that those are just predictions and what we see inside of the market. Sometimes we do this live, so this really doesn't apply to anybody on the webinar this evening. Moving right along, a little bit about your speaker. Myself, my name is Derek Eichenwald. If you hear an accent, I originally am from Massachusetts. I have the distinct pleasure serving as the CEO and Senior Investment Executive with Triumph Capital Management. And I've been in the business for some time. I'm a dog lover, as the picture can maybe show. We do welcome questions. At the end of tonight's webinar, we do have a lot of people on, so if you do have questions, please contact myself or contact the firm directly. We'll be happy to answer them, but we won't open up for questions per se as we go through tonight's webinar. Tonight we'll be unpacking a number of things, but to give you a little bit of agenda, we'll talk about the review of the first half of the year. In fact, I'll go a little bit past the first half of the year and bring into some of the stuff that's happened in July. We'll give you a second half of the year outlook. We'll talk about where we are now and give some forward-looking statements about what we see happening for the rest of the year, as well as we get into 2024. So let's talk about the first half of the year. The first half of the year was dominated by three themes: inflation, the Federal Reserve and their interest rate hiking, and recession fears. As you all know, we saw inflation continue to moderate, in other words, come down, and we also saw the Fed continue to raise interest rates, obviously bringing into the economic picture some fears of, hey, we're going to enter into recession. When the Federal Reserve goes to raise interest rates, the intent is to slow down the economy. And of course, the definition of recession is a slowdown in the overall economy. With that all said, the stock market performed extremely well. In fact, for the first half of the year, on June 30th, the market was up. When I say the market, I'm referring to the S&P 500. The S&P 500 looks at 500 of America's largest companies, but we were up about 17%, about 16.9%. By the way, that was the S&P 500. The Dow Jones Industrial, on the other hand, that looks at 30 of America's largest companies come the first half of the year, was only up 3.8%. That said, the S&P again up nearly 17. And so, you know, why was the market, or how come the market was up as great as it was, up 17% in 6 short months? Well, we saw inflation coming down. Remember, last June, we hit a high of inflation of north of 9%. We saw that inflation number come down to where we are today. I'm going to show you where we are today as we unpack things today. And last year, one of the hardest hit areas of the market was the tech sector and the communication sector. The NASDAQ was down nearly 40%. This year, those sectors are the ones that are driving the market. I bring that up because when I talk about the S&P 500, so many people believe that it's equally weighted. Well, as you can see on the screen in front of you, and give me a second here, I'm going to bring up a drawing tool. You notice that here are the weights. Energy, for instance, represents 4.1% of the S&P 500. Look at technology representing 28%, and look at communication services representing 8.4%. Now, a lot of times people think about these two sectors and they kind of lump them together as tech. Well, to give you an example, tech, companies like Apple, Microsoft, NVIDIA, so on and so forth. Well, what sits in the communication sector are companies like Facebook, Google, and Netflix. But together, this, I'll kind of call these the technology sector, they represent nearly 40% of the S&P 500. And with that said, look at the returns. So year to date, and again, this is as of 6:30, the tech sector up 42.8%, communication sector up 36.2%. You do see some areas like consumer discretionary, that's discretionary spending by consumers, up 33. Look at energy, down 5.5. Look at healthcare, down 1.5. So 2 points that I want to make here. Point number one is that the S&P 500 is not equally weighted. You can see obviously technology and communication services representing the lion's share, 40% of the S&P. And because of those different weights, how those sectors perform really dictate how the market or the S&P 500 performs over lengths of time. Again, you can see that up 16.9. I bring this up because I said the Dow being up only about 4% for the first half of the year. The Dow isn't nearly as weighted inside of the tech sector, right? It only represents 30 of America's largest companies. So I talked a little bit about inflation, and if you go back and you review any of the past webinars that we've done, we kind of said this. We saw inflation coming down. There's an old saying on Wall Street, and that old saying is you don't fight the Fed. The Fed has been raising interest rates with the intent to cool down inflation. Now, of course, as I said earlier, when the Fed raises interest rates, the intent is that things break. We saw some things break, like regional banks. We saw unemployment. Unemployment actually has been holding pretty steady, but we saw some things break. I'll unpack those for you. What you're looking at here is you're looking at headline inflation. Now, I said last June we had a high of 9%. Headline inflation includes food and energy. There's also what's called core inflation, and core inflation strips out food and energy because they're two volatile areas of measuring inflation. Now, when we look at it as a money management firm, we always like to look at headline inflation. Why? Because headline inflation affects you and I. What we pay at the pump, what we pay in the grocery store affects what we do with our wallet. It affects what we spend our other dollars on. But you can see headline inflation back in July of 2022 was at 8.5. The Federal Reserve, through their interest rate raising program, so on and so forth, has tamed inflation. We also have seen gasoline and food prices come down, but our last reading on inflation, which we just got on the 12th of July, so just a few, just 2 days ago, one of the reasons why the market's done extremely well over the last 2 days is inflation was expected to come in at about 3%. The headline inflation reading came in lower than 3%, just a tad lower, but the markets obviously react extremely positive to that. The next slide, it's not a slide, this is just going to be replaced by core inflation. Now, core inflation strips out, again, food and energy. However, when you strip out food and energy, quite interestingly, you can see that core inflation came in at 4.8. Again, better than expected. Expectations or the consensus was that we would see core inflation more around 5%. That said, let me remind everybody, the Federal Reserve has a dual mandate. The Federal Reserve deems they want to have inflation at 2%. When they say 2% in their dual mandate, they are referring to core inflation. They want to see core inflation at 2%. Again, our last reading of inflation came in at 4.8. That was 2 days ago. Watch this screen again. Excuse me, apologize. Wanted to make some more comments there. And so, on the headline inflation front, it's very positive, and I'll unpack some of the reasons as to why it was very positive. We also saw core inflation come down. It was quite a steep jump, as you can see there. And again, if you go back in our previous webinars and take a look at them, you'll notice that we said, hey, we should start to see both headline and core inflation come down, obviously. Let's kind of change topics for a second. Just want to kind of wet your beak with some information, and we'll dive into these topics a little bit more. So we've talked a bit about the S&P's performance so far this year, and we want to kind of explore how that performance compares to expectations. So at the end of each year, media outlets, Wall Street companies, and analysts give some projections of where they see the S&P 500 ending the year. What's on your screen right now is some of the larger firms on Wall Street and where they predicted the S&P would end in 2023. As you can notice here, the group average came out to 3,800. Well, on June 30th, the S&P 500 closed at 4,450. By the way, the average uptick from these analysts from where we began the year for where we ended the year was only a gain of 5%. The markets continued to run. We've had a fantastic July, and you can see that making forward predictions about where markets will end can be very difficult. And I point that out for that particular reason. If I fast forward and I look at it as of the close of business today, the S&P 500 closed at 4,510. It's now up about 17.5% for the year. Interestingly, as you can see, the headline on the slide says the Dow, again, the Dow's been pretty darn flat. The Dow's up 3.76% as of the close of business today. So, let's talk a little bit about the second half outlook and different market forces that are affecting the economy. Let me bring you back to January of 2022. I'm sure when I said that in your minds, you all said, hey, 2022 was an awful year for the stock market. I mentioned something earlier, and that was that the NASDAQ was down nearly 40%. The bond market was down nearly 17%. However, if you go back and you look at economic indicators in January of 2022, they all look pretty darn good. In other words, the Fed was raising interest rates, but interest rates were still very low as we started 2022. The economic outlook, when they surveyed a handful of corporate leading CEOs, was very positive. The yield curve was sloping in the correct direction. Consumer sentiment, people were feeling very positive. Disposable personal incomes remained very strong. The labor market remained very strong. We'll talk about these things a little bit more. And you notice here, right, the housing market, mortgage applications, consumer spending, interest rates in the beginning of 2022 weren't that bad. We were at about 4%. Of course, we shot up in June to 9%. Business surveys were coming in positive. You notice that almost all of our indicators in green. However, political environment, I've been thinking about removing this because it's always kind of in the red, right? Geopolitical risk is something that's always kind of in the red. Equity market valuations at the beginning of 2022 were in the red. We'll talk about that, PE ratios. But let me fast forward to January of 2023. This is what the economic indicators looked like 7 short months ago. Monetary policy, right? Now in the red, the Fed increasing interest rates astronomically, 2,000% over the last year and a half, okay? Economic outlook, will the consumer continue to be able to spend? The yield curve is now inverted. I'll unpack and explain what that means. The labor market is still very strong, but it's getting tighter, which I'll show you. We see inflation. Inflation is taming, okay? But inflation's still very high at 4.8%. I fast forward here to June. And if we look at June, the indicators really arguably they've not improved, they've gotten worse. Well, wait a minute, Derek, you're showing me economic indicators that are in red and yellow, and the stock market's up 17, 18%. We'll unpack some of these things. I'll explain why. The first thing that I'll start with is PE ratios, okay? So you've all heard me explain these before. But the first thing that I want to say is There's an old saying, and everybody likes to say it, and it's always buy low, sell high. And so, how do you know when you're buying low and selling high? If you think about it, if you go and you shop for, let's say you do the grocery shopping in your house, or you do whatever you do for a living, you know where the average cost of something is. Well, when it comes to the stock market, people don't really have a feel for that, but there is a feel for that, and it's called the PE ratio. Let me explain what the PE ratio is. Pretend for a moment you and I own an ice cream store. I say this because those of you who are familiar with Denver maybe know Little Man Ice Cream. I happen to live near Little Man Ice Cream and I drive by it every night. For those of you who are not familiar with Denver, Little Man Ice Cream is like an outside ice cream parlor. During the summer months, there's an enormous line outside of it. And interestingly enough, even in the winter months, there's a line outside of it. It's kind of a cool place. Um, but let's pretend we own an ice cream parlor, and let's just pretend for a moment we made $1 million a year, top line. Well, from there we go and we pay our employees, we pay our rent, we pay our suppliers, we pay our overhead. And let's pretend after we pay all of our overhead, we're left with $100,000 of bottom line revenue. Now I want you to pretend with me for a moment that you and I have owned this ice cream store for the last 30 years and we want to go and sell it. Well, Little Man Ice Cream, or our ice cream parlor, is not publicly traded. It is what is called privately held. Privately held companies typically get a price tag of someplace between 3 to 5 times earnings. In other words, if we went to go sell our ice cream store, we would receive a check for $300,000 to $500,000, 3 to 5 times our bottom line. When it comes to publicly traded companies, when we look at the PE ratios of the S&P 500, lumping all those companies together, of course, there are some that have a PE ratio that's very high, some that are very low. But when we lump those all together, what we come out to is we come out to a mean on the S&P 500 of about 16, as you can see on my screen. Now, that 16 comes from data from 1880. If I throw out that data from 1880 and really just start to look at the market from about 1940 onward, okay, that means a little bit higher. It comes in at about 17, okay? So if you think about buying low, selling high, what you try to do is you try to find companies that are selling below a PE ratio of 17. And when I say PE ratio, let me just explain that. I gave you the ice cream parlor example, 3 to 5 times. When it comes to publicly traded companies, let's pretend for a moment our ice cream parlor was publicly traded. Again, all the same financials. We made $1 million. We were left with $100,000 of bottom line revenue. And let's pretend we went to go sell that company today. We would fetch, if we were publicly traded, not 3 to 5 times earnings, but on average, we would fetch about 17 times. In other words, we would get $1.7 million for our ice cream parlor if we went to go sell it. Derek, why do publicly traded companies get 17 times earnings while privately held companies only get 3 to 5 times for their valuation for a sale price? The answer to that is very easy. It's what is called the liquidity premium. In other words, if tonight on the news it is said that ice cream causes cancer, and you and I own a privately held company such as an ice cream parlor, all of a sudden that line outside of it starts to dry up. People stop eating ice cream. What happens is our revenue goes down, right? Well, Derek, if it was a publicly traded company, wouldn't they stop earning money? People wouldn't be buying as many carts, pints of ice cream in the grocery store. Certainly. But if that report came out tonight and you own a publicly traded company, with the click of a button, you are out of the ice cream business. When you own it privately, think about the time it would take to sell that company. So publicly traded companies get about a 12% premium, which is why they're at 17 versus 3 to 5 for liquidity. So where are we today on PE ratios? We ended today on PE ratios at 26 on the S&P, well above the mean of 17 and the mean since 1880 of 16. Okay, so company prices are high today. Okay, let's keep that in mind. We'll come back to it. We talked about inflation by the numbers, and again, of course, inflation's been coming down. And why is that? That is because the Federal Reserve has steadily been increasing interest rates. As some of you may know, we started in March of 2000. Okay, the federal funds interest rate was at 0.25. It's why you could go out there and refinance your house and get a mortgage at 2.6 or 3%. Okay. It is also why when folks are out there shopping for homes today, they are getting interest rates of 6.5 to 7%. Remember, the Federal Reserve has three main functions. They have a dual mandate, but they have three main functions. Function number one is to provide an effective payment system in the United States of America. Function number two is to regulate banking operations. And function number three, which is really their big function, is to set monetary policy. Okay. What they've done is they've brought the federal funds rate, and I'll explain what that is in a minute. They brought the federal funds rate from where it was right after COVID, 0.2, to where we sit today at 5.25. Now, listen, what the Federal Reserve is and what the federal funds rate is this. It's the rate that the central bank, the Federal Reserve is the central bank. It is the rate in which they lend their member banks money. In other words, the Federal Reserve turns around and they lend Wells Fargo, for instance, money at 0.25. That was a few years back. Wells Fargo turns around and lends it to you at 3%. Wells Fargo makes the difference. They make that delta of 2.75. When the Federal Reserve raises interest rates, okay, that effectively raises the rate that Wells Fargo has to pay in interest to the Federal Reserve, and therefore they turn around and they lend you money at a higher rate. Also, the federal funds rate affects things like credit cards. So if you think about it, think of somebody who has $25,000 of credit card debt. And let's just say that person every single month pays the minimum payment. Well, what's happened to that person over the last 18 months is all of a sudden that interest rate, interest on credit card is very high, call it, 18 to 22%. Well, with the federal funds rate moving upward, okay, that person's minimum payment maybe went from $250 a month to $500 a month. That's not even to eat into the principal. That is just to maintain the interest that is due on that debt. Now think about that for a second. If that person has to pay more to maintain that debt, okay, they used to pay $250, now they pay $500. They have $250 less in their pocket to do what? To spend on widgets. What is every company on Wall Street doing? They're selling a widget of some sort, of some kind. And so when you saw the markets do so poorly in 2022, one of the reasons for that was that, hey, earnings should be going down. Because think of your consumer's out there, and if their cost of money is higher, they have less money to spend on widgets. It explains exactly why in 2022 the tech sector was so hit. Isn't it so easy to turn off your Netflix subscription? Isn't it so easy to cut the cord and things of that nature? Okay. And the Federal Reserve does that to cool down inflation, right? If everybody starts cutting the cord or canceling their Netflix or whatever the case may be, the price of such items would come down. Because of the Federal Reserve's interest rate rising policy, okay, again, we've seen inflation come down. I'm kind of hitting some topics here, but I'm going to wrap it up in a nice bow for you here at the end. Also, when the Federal Reserve starts to raise interest rates, typically what we start to see is we start to see unemployment rise. Now, unemployment in the U.S. has been unbelievably strong. Remember the dual mandate from the Fed, inflation rate at 2%, and they like to see unemployment at 4%. Now, when I say that to some people, they look at me and they go, 4%? What do you mean? Why would they want it at 4%? Why not 0%? Let me unpack that for a moment. They find that 4% is not too hot, not too cold. In other words, pretend you and I own a company and we need to hire a graphic designer. We want them to work for us internally. Maybe we are in manufacturing for boxes or whatever the case may be. We put an ad out there for a graphic designer to do the design for the box and what have you, and we put an ad out there for 80 grand. Maybe we get no responses to our ad, right, to hire somebody. So we have to increase it. We then put it at 100. We put it at 200 salary, okay? And as we increase the wage that we may potentially pay somebody, we might get some applicants. When you have an unemployment rate that is too low, what happens is employers need to raise wages, okay, which is inflationary in itself. And what you have is you have companies that can't hire. So again, they find that 4% is the right number. Well, over the last 18 months, the United States of America has been trending well below that 4% number, and the labor market's been tremendously resilient. Now, listen, if you notice here, okay, this is simply showing us the amount of job openings. At the time, there was 2 job openings for every unemployed person. As you can see today, that has come down. In other words, today there is about 1.2 jobs for every unemployed person. You would think we should start to see unemployment go up. We've kind of had unemployment hanging around 3.5%. We did see it matriculate up a little bit to 3.6 to 3.7. Our last reading was unbelievable. Expectations were that we were only going to add 100,000 jobs during the month of June in the United States of America. We added about 250,000 jobs. And so that's not good. Like when I say that's not good, let me explain. It's good. It's good news. You want jobs. But at the same time, the cloud that's kind of over the market, kind of this tippy-toeing that everybody's worried about, is inflation. And when you have unemployment that stays below that 4%, it's inflationary in nature. Well, what we had a great inflation reading. As I showed you, we saw core come down from 5.2 all the way to 4.8. We saw headline drop tremendously down to like 2.4. Now remember, headline includes food and energy. And remember this, energy way down. Energy way down, okay? But when it comes to the labor market is this big engine, right? You got more people working, more people spending money, therefore companies are selling more widgets, so on and so forth. Federal Reserve raises interest rates. They want unemployment to go up. Why? Because it helps cool inflation. We're getting that today, but we still have a tremendously strong labor market. I ask people all the time, clients, after doing this for 22 years, a lot of clients that work in a lot of those different industries, energy, tech, and all over the board. Over the last 2 years, I can tell you this, my phone would ring, it'd be a client who's maybe been with an employer for 10 years. And they say, Derek, listen, for the last 10 years, I've been working at ABC company. I've been making, let's say, $250,000 a year. Hey, I got a call from our leading competitor. They want to pay me 300 grand a year. Derek, I'm calling you because I would like you to look at my benefit booklet and talk to me about the 401k and the health insurance and everything else. And I would. Sure enough, 6 months would go by and my phone would ring again. And it would be that same person, and they'd say, Derek, you wouldn't believe this. Our third biggest competitor gave me a call. They want to pay me 325 grand a year. Do you mind looking at my employment booklet, my health insurance, and oh, by the way, I got to roll over my 401k. Interestingly enough, over about the last 7-8 months, my phone's not ringing with those phone calls anymore. I was out with a client yesterday for lunch who said to me, Derek, yeah, you're right. She runs a very large manufacturing company, also located here in Denver. And she said they noticed the same thing. She also mentioned to me that they have a difficult time hiring new people today because of the wage. I'm going to unpack that a little bit further, which is why you see this. This is kind of weird. Look at job quits. We hit a peak last year in job quits, right? And today we're still really high. Wait a minute, Derek, we got this really strong labor market. What do you mean quit? Exactly what I just explained. It's not because people are quitting and staying unemployed, moving from job to job. It's also why down here you see layoffs. Layoffs last year, we hit the lowest since 2000. We're still extremely low. Employers are dying to hire people. They're not looking to lay off people. That all said, number of job openings down, people quitting down, okay? Layoffs rising. Again, you would think maybe that's bad news, but again, we want to get to that 4% level, and we've been below it for so long. So as this news that would otherwise be bad news, right? More people are quitting, employers are laying people off. You would think that is bad news. The market likes it. So it's like good news is bad news, okay? Or bad news is good news, rather. I'll talk a little bit more about this as we kind of work through tonight's stuff. This is one of my favorite charts. You have all seen this. This is the consumer sentiment. As you all know, the University of Michigan reaches out to 500 households every single month by phone, and they ask them basically 10 questions. They say, hey, listen, if you were to describe your financial situation today versus a year ago, do you feel good, bad, or indifferent about it? Hey, listen, you know, over the next 12 months, do you plan on traveling? And they take a survey. Since 1971, this is what this chart is plotting. You can see where the numbers came in at. The blue dots are indicating where the numbers come in at, and this blue line down the middle is showing you an average of 85. The reason why I like this chart is because of this. Consumer sentiment's super important. What I mean by it being super important is it is talking about how does the consumer feel? When the consumer feels good about things, they tend to spend more money. When they don't, they tend to spend less money. What do I mean by that? For those of you who remember, let's go back to 08, 09. Let's pretend in 08, 09, where we had a huge market recession, maybe in your neighborhood, so on and so forth, you had what we like to refer to as yellow lawns, right? People moved out of the house, nobody moved in, it's not getting watered, the lawn started turning yellow. Maybe in the neighborhood that you live in, it was during the summertime and there was a barbecue. And you're at the barbecue, you and your wife, you and your husband, and one of the neighbors says, oh, geez, did you hear John up the street lost his job? They're having a really hard time with it. But let's pretend that consumer works in an industry such as education. Let's say they work in education. In education, economics, stuff like this, right? Like tech bubble, but a lot of tech people lost their jobs, so on and so forth. You work in education, you're not really at fear of losing your job. The schools aren't shutting down, right? But psychologically, you might say, I'm going to hold off on making that purchase. Things, you know, I want to save up a little bit of money, that type of thing, right? So it's all psychological. But when people feel good, people say, hey, you know what? Money's coming in. I got a raise at work. No, I'm not getting a lot of bad news. They go out and they spend money. It's what happens. What this chart shows you, okay, and it's very interesting, is it shows you, hey, here are readings dating back all the way to 1971. And then when you see this percentage next to it, it talks about what the S&P 500's return was over the next 12 months. So check this out with me. Let's kind of look over here. Let's go. Here's 1980. 1980, we had an extremely low consumer confidence number. In fact, in 1980, we had a short little mini recession. It's no wonder when the University of Michigan asked these questions, people said, hey, I feel horrible. I'm not going on a trip over the next 12 months. No, I don't feel better about my financial situation. However, look at the market return from May of 1980 to May of 1981. It was a positive 20%. Let's go over here and let's look. This was January of 2000. A lot of you remember that, right? That was like almost at the height of the tech bubble, right? We started to see the tech bubble burst as we got into mid 2000. Look at that. One of the highest readings, if not the highest reading we ever received, well above the average, right? Consumer sentiment's coming back. People are saying, I feel great. I got more money than God, blah, blah, blah. I'm going on 5 trips over the next 12 months. That was the S&P 500's return from January of 2020 to January of 2021. Now let your eye examine this. These are all high readings, above the average. Look at the return, -6, -1, you know, +13, not bad, -2, +4, -4, -2. Catch my drift. Now let's look at these negative readings. I showed you all this. I showed you this back in a webinar that we did a year or plus ago. We had the lowest consumer sentiment reading in history, okay? And that was back in the summer of 2022. It was the lowest consumer sentiment reading in history, okay? And I said, listen, nobody can predict the future, but we look at a lot of different data points, okay? And, oh, by the way, as I just mentioned to you, from June of 2022 to June of 2023, S&P 500 up 17.6%. Our latest consumer sentiment reading, obviously very much improving, but our latest reading at 64, well below the average, but people are feeling better. We'll talk a little bit more about that. Also, one of the biggest things that happened in the news over the first 6 months of the year was the regional bank stresses and regional banks shutting down, such as Silicon Valley Bank. I could do an entire presentation on Silicon Valley Bank or the regional banks that shut down, why they shut down. By the way, an enormous factor inside of that was the Federal Reserve raising interest rates and what that effect has on the price of bonds. If you're interested in that, please let me know. I'm more than happy to show you that. I believe if you go to our website and you go to our past recordings, there is some stuff on that, but I'm more than happy to unpack that for you. It's quite interesting, and it speaks to a lot of what's going on in the market today. But of course, with the shutdown of regional banks, the dry up of credit, that caused some shocks inside of the stock market. Why? Because, hey, who else is exposed? Who else is exposed to that? And I got news for you. Every bank is exposed. Every single bank is exposed. Silicon Valley and some of your smaller regionals, just it was a little different situation. Okay. So listen, what's in half for the second part of 2023? Well, before I do that, let me go back and let me just hit a quick few topics that I maybe glossed over. Okay. So I talked about where inflation was. And then I showed you these like negative indicators, and I said, hey, P ratios are really high. And I said to you, you like to buy when P ratios are below 17, and you like to sell when the P ratio is above 17, which, by the way, some of you have noticed, right? Because P ratios, it's not like they've been at 26 the entire year, right? We've kind of seen that happening over the last few weeks. And for those of you who are clients, you've seen trading activity inside of the account. We've been taking profits. We've been selling companies with P ratios well above their means, okay? But, you say, hey, listen, major Wall Street firms only predicted on average a 5% growth. Here I am, June, I'm up 17, even better if I include the first, few weeks of July. Why in the world's the market doing so well? And it really boils down to this, okay? It really boils down to this. Headline inflation. Headline inflation, again, includes food and energy. But again, I like to look at that because that affects you and I. That affects your consumer, okay? Well, look at, in 2022, the entire fear was this. Federal Reserve's going to raise interest rates. They're going to be too aggressive. They're going to lead us into recession. We're going to have a hard landing. In other words, unemployment will spike up to 10%. People won't be able to afford things. Well, interestingly enough, when I talked about the labor market, and I talked about how strong the labor market's been, if I look at wage growth, okay, from May of 2023, we don't have June's numbers yet, backwards to May of 2022, we had wage growth of 5.736, okay? Wage growth of 5.736 year over year. Now remember, for those of you who have been on historical webinars and inside of presentations, I always said, hey, inflation, yes, is a problem, but if wage growth is north of inflation, the stock market will hold up. And listen, that occurred through 2022, but the stock market's a forward-looking indicator. It was like, this can't hold up. Well, what did we have? We had inflation come down. There you go, headline, right? And if I go June 23 to June 22, 2.97. Therefore, your average consumer out there over the course of the last 12 months, in fact, got a 3% raise. They increased their wages by 3%. At the same time, okay, companies through the pandemic and through what they saw coming inside of here, tech companies, okay, and tech communication companies, which are the leading sectors of the market thus far in 2023, Those companies laid a lot of people off. Twitter shedded 85% of their workforce. You saw Facebook making massive layoffs, so on and so forth. Okay, why? In anticipation for this happening, but it didn't put a dent really inside of the overall nation unemployment rate. But again, the biggest thing and the most important thing is, listen, what's every company doing? They're selling a widget. And if all of a sudden inflation's eating up the consumer's wallet, I gave you the example of the credit card. There's more examples of leases and cars and so on and so forth. And then it gets even worse, right? Are people going to start defaulting on their mortgage because these other areas eat up too much of their wallet? Well, in actuality, what happened, and we said this, if you go back, we watch this every day, is wage growth going to be above inflation? Now, when I say we watch it every day, you only get the real Bureau of, you only get the U.S. Bureau numbers once a month, okay? But it really did held steady. And when you go back and look over a 12-month period of time, again, on average, it's a 2.76. Well, I'm just going to call it 3%. That's that delta. So people got a raise. It's no wonder that as we got into 2023, okay, and we saw inflation dropping. You can see, right, there's 23. You can see inflation dropping. Well, guess what? Labor's sticky. So think about that story I told you earlier, right? Somebody calls me up, they're moving from place A to place B and then again to place C. It's not just the salary for the company. They got to spend time training people. They're spending money on human resource people to train these people. So it costs the company a lot more. They don't necessarily immediately go out there and start firing, right? They've cut costs in other places and have employed new technologies to make the business run more effectively. And because of this, the street or the market is saying, hey, wow, can this continue to keep up? And that is combined by a few other things, which I'll unpack as we talk about our predictions for the second half of the year, which I'm going to now, okay? So let's kind of move forward here, right? All right, second half of the year. The questions really for the second half of the year are, will the market continue to run? What's going on with the Federal Reserve? Will companies continue with their profitability? And will wage growth continue to supersede inflation? Okay, so let's kind of answer those. The first thing is let's consider the variables that weigh heaviest on market performance, all right? And when we consider the variables that weigh heaviest on market performance, or at least what has over the last 18 months, is this conversation of inflation. As I always say, you can't fight the Fed. You just can't fight the Fed. The Fed is going to fight inflation. So we're going to see inflation come down. I think that's without a question. The question is, really, it's no different than a physician perhaps treating a patient, maybe a patient who has cancer, right? And the physician knows, hey, if I give them chemotherapy, if I give them these types of things, it can harm these other areas of the body, but I might kill the cancer, right? We've all heard that. For those of you tonight that are physicians, you all know that. So it's the same kind of procedure, right? You increase interest rates to kind of kill inflation, but do you cause a recession in the rest of the market? And the answer to that is those have been the fears. Listen, 26th, not this Wednesday, next Wednesday, we have the federal funds rate decision. The Fed kicked the can. They didn't raise rates in June. I was surprised by that. Okay, I thought they would raise rates. I thought we would go to 5.75, and I thought they would also raise rates this month in July, which the meeting isn't until the 26th. Again, I do think the Federal Reserve will raise rates by 25 basis points at their meeting on the 26th. The market right now, because inflation came down, is reacting very positively, but the market will react positively or negatively, not necessarily to the Fed raising interest rates on the 26th. In fact, I think the market believes that the Fed will raise interest rates on the 26th by 25 basis points. The market will react to Jerome Powell's comments after the interest rate hike. The questions will go something like this. Mr. Chairman, you guys have risen interest rates now at an unprecedented level, 2,000% over a year and a half period of time. It takes time for that interest rate hiking to build its way into the economy. We've seen inflation get cut in half. Now remember, what the Fed looks at, they do look at both inflation numbers, but they focus on core inflation. Core inflation's at 4.8. Their target's 2, okay? So we're still a long way away from 2, right? And Powell's going to answer those questions aggressively, as he has at every press conference over the last 2 years, okay? I believe he will answer those. He'll say, we're going to do what we need to do to get the inflation closer to our target of 2%, okay? Which means they're going to continue to raise rates. They're going to continue to raise rates. Now, look, I also believe that we're closer towards the end of their interest rate raising cycle than obviously we have been, right? We obviously, right, when inflation was at 9, at 8, so on and so forth, we've seen it get cut in half. We're getting closer to that. That's another thing that the market believes, the stock market believes. Hey, listen, yeah, they might raise a few little bit more times, but they're eventually going to stop raising. So we're near the end of it. That said, I don't think Powell, in his comments, in his answers to his questions, is really going to give that type of indication. Now, I think that's what they're doing behind closed doors, but I don't think he's going to push that out into the general market like, yeah, we're done, okay? The other part about it is recession concerns. When the Federal Reserve raises interest rates like that, it is intended to make things break. One of the biggest breaks we saw was regional banks. Okay, again, 98% of that was caused by the Federal Reserve, believe it or not. And so, listen, if they continue to raise, are they going to raise too much? Is that going to cause a deep recession? Are we going to see things go to heck in a handbasket? And the last thing in the headlines will be corporate profits. Next week, we enter into bank earnings season. So we're going to see how the banks are doing, right? Now, one of the indicators that I showed you earlier was mortgage rates. Last month, we had the lowest mortgage application rates in the last 25 years, okay? Now, if you think about that for economic activity, think about what happens when somebody buys a house. They take a loan out. When they take that loan out and they buy that house, think of the ripple effects, right? They typically buy new toiletries, they're buying new towels, they're buying new TVs, right? There's a lot of economic activity that takes place. Last month, lowest number of mortgage applications in 25 years. It's no wonder because the 30-year rate's at 7%. Okay, people ask me, well, Derek, based on that, do you see the real estate market coming down? I see the real estate market not going up. I see the real estate price coming down a little bit, no more than 4%. Why, Derek? Lowest mortgage rates, right? But my price of my house is pretty stable. In fact, it ticked up a little bit. Yeah, goes back to 08. In 08, right after the financial crisis, 08, 09. Banks weren't lending to any builders. There was no building that was occurring in the, we started to see that pick up come 2013, but there was really no building that was occurring. Today, you drive around, you see a lot of building happening. Why? Because the supply for housing is huge. And I mean, the demand is there, right? Because there wasn't the supply. So that's helping keep that real estate market pretty darn stable. But I do think we'll see real estate come down about 4%, but nothing really severe, okay? I think companies, sorry, I should flip the slide here. I think companies continue their earnings. In fact, I think earnings will be pretty darn good. I think will level out. We won't see as strong as they have. Why? Listen, I think that there's some areas of inflation that are pretty darn sticky. We have a huge labor market. And I say to people all the time, listen, the effects of the Federal Reserve raising 25 basis points do not have the same effect as they had in the 80s when they were fighting inflation. Why? The economy's nearly quadrupled the size. And so think about this. You're in a little speedboat, okay? You take a left-hand turn in that speedboat goes whoop, and it makes the left-hand turn pretty quickly. Now pretend you're in like a boat the size of the Titanic, and you do that same thing with the wheel. The Titanic doesn't turn quickly, it turns slowly. The size of our economy, the size of our labor market, our population, much, much bigger. So the effects of a rising interest rate environment simply, they still have an effect. It just takes longer to turn that boat, okay? And because of that strong labor market, because of the size of that labor market, because of the fact that there's still more job openings than unemployed people. Because of all of that, wage growth is going to stay strong a little bit longer. Now you'd say, well, Derek, isn't that good? Because if inflation's coming down and you have wage growth that's stronger, you get a bigger delta than that 3%. It is good. It is good for companies. They're earning, they'll sell more widgets. But the Federal Reserve will continue to fight that with rising interest rates. And the biggest concern is, does that drive us into recession? So there is some sticky CPI out there. But, it's actually moving pretty good, right? Like, we see these things. We like to see that delta between inflation and wage growth around 2%. Again, that's that not too hot, not too cool number. We like to see that around 2. So you see a little hot right at 2.76 over the last 12, but definitely coming down. Let's talk about some more things. So, what's ahead for short-term rates? As I mentioned earlier, we get the Federal Reserve's interest rate decision on July 26th, Wednesday. Now, the Federal Reserve always has 2-day meetings. And so the first day it's behind closed doors. You don't even know what they're talking about. The 26th, they come out in the afternoon. They announce their decision, either keeping rates flat, increasing, decreasing, and then there's a question and answer that goes on for about an hour. I believe July 26th, we will get a 25 basis point hike. So where do we see things going? We see things going like this. We see wage growth should slow. Why? I just got through telling you Titanic, blah, 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 blah. But I also got through telling you, listen, my phone's not ringing from the same person 2-3 times in 7, 8, 9 months telling me they switched jobs twice. So I'm seeing that slow down. Also, as I showed you in the graph from the Bureau of Labor, we see job openings coming down. They're still extremely strong, but we see them coming down. Yeah, we got a really hot labor market in June. But the interesting thing is, listen, if you look at the data, June tends to be a weird month. Why? Because you got a whole bunch of kids that are off of school. You got a whole bunch of college students off of school. They're looking for summer jobs. It's one of the same reasons why we start to see it, like in January, we typically get like a bad labor number. Why? There was seasonal help, right? And they all quit, or they don't get fired, but they're like, hey, I'm here for the holiday season, and they're out, and, we get the December number in January, and so it looks bad. And so I think there was some of that baked into June. Obviously, the Federal Reserve knows that. But I think that, we're not seeing people switch jobs. We're seeing job levels, we see wage growth start to cool. We see unemployment rising. Now you would think, hey, that's got to be bad. Well, listen, it's non-inflationary. The question is, does unemployment shoot up to 8, 9, 10%, which would cause a very bad recession, or do we get that type of soft landing that the Federal Reserve wants to accomplish, and we get the unemployment rate to around that 4 or just slightly above it? I think we will see it rise. It's been very, very stagnant, right? 3.7 is our last read, and it's been dancing between 3.5 and 3.7 year over year. But with, you don't fight the Fed. With them raising rates, they'll get that unemployment number, to 4 and above. We think corporate profits will basically remain pretty steady. Again, companies are going through this very well. Again, it has to do with that consumer. The reason why companies are faring well is the consumer's faring well. They actually got a raise over the last 12 months. That said, we think as we get to the end of July and into August, we'll see a slight sell-off in the market. Why? Remember earlier I said to you, hey, P ratios are at 26, and I said on average they're at 17. Everything reverts to the mean. Everything reverts to the mean. And so it's either that corporate profits grow so much that the P ratio comes down, but stock prices stay high, or stock prices come high because earnings season isn't as great as expected. What I think during earnings seasons, again, we'll enter into bank earnings season next week, but then we'll get, we start to get Q2 numbers as we move along here into July, into the last few weeks of July. The consumer, in large part, again, you saw consumer sentiment rise. You're seeing people comfortable with their jobs. You see full employment. But unlike it was kind of before, where people had maybe some savings inside of there from COVID, or there was a lot of free money out. That's the kind of stuff is sloshed down. Consumer, it's no wonder they're feeling better. You know, you think about it, you got an advertisement on every corner of every street in America with the price of gas. We've seen gas come down for the year. We're down about 6% in the price of gas for the year. But with that said, I think we'll see corporations' profits kind of even out or go down a little bit, not catch up with P. So I think we'll have a slight sell-off as we get into the later summer weeks and the later summer months here. But I think we'll have a strong finish into 2023. Why? Well, the Federal Reserve themselves, this is from their website, shows this is the federal funds rate. They show themselves starting to cut the federal funds rate, okay, as we get into late 2023. Now, the reality is I don't think they're going to be cutting rates in 2023 at all. I already explained all the reasons why. I think they'll continue to fight inflation. I think if you look at this graph, these are, you know, market expectations and where the Federal Reserve does have a long-term goal of having the federal funds rate, as you can see here, at 2.5. It's a question of how we get there. What I think we will see is we will actually see the Federal Reserve probably raise interest rates without a doubt on the 26th. And I think we'll actually probably see 2 more raises after that. We'll see 2 more raises after that because the labor market's just so strong. As that happens, okay, and as he doesn't give a rosy, you know, speech on the 26th, market kind of sells off. But what we then get towards the end of the year is a Federal Reserve that says, hey, we're done with raising rates. Listen, if unemployment continues to tick off, of course we'll use our monetary tools. What does that mean? Because they never come out and say it. That means they cut rates. Everybody's talking about, will they have a soft landing, a hard landing? I say they're going to kind of have a soft landing. Why? Because now they have a parachute. I've said this before. I was really scared when the federal funds rate was at 0.25. Yeah, it was great. Money was really cheap. But what was left in their monetary tools, right? How do you go below 0? Today, they're at 5.25, going to 5.5. I think they'll end up at 6, you know, 2 more rate hikes at 25 basis points, and they'll be able to cut rates. And guess what happens when they cut rates? Even though mortgage applications are really low, there's a whole bunch of people that have been purchasing homes and have been throughout the course of the year. And again, I already talked a little bit about the economic activity. Well, no different than them making the economy slow down. When they cut rates, the economy speeds up. Why? Because all those people who purchased real estate, okay, they get to go refinance. And what does that do? That causes velocity at the bank as far as mortgage applications. There's fees involved for that. Also, all of a sudden, that person that used to have a mortgage payment of $3,000 a month, now their mortgage payment's only $2,500 a month. They have an extra $500 in their pocket to spend on widgets. That credit card example that I gave you, all of a sudden, that guy's minimum payment comes down. He's got more money to spend on widgets. This is yet another reason why the market is kind of rosy today, right? Why P ratio is so high. Markets get bid up, but the market's looking at it going, hey, listen, we're probably towards the end of the Federal Reserve raising rates, and then eventually they'll start to cut, and the market is again a forward-looking indicator. Now look at, 2022, all this same stuff was happening. All the same stuff was happening. There was no reason that the market should have sold off as greatly as it did in 2022. It's just that, listen, we have inflation at 9, right? The market had a tough time seeing that come down as dramatically as it did. And now the market is kind of agreeing with what I'm saying. I think the market has it wrong a little bit. In other words, I think inflation will be a little bit stronger than it is, and the Fed will raise a little bit more than what the market's predicting. And that's the reason for the end of the summer sell-off, with a rebound as we get to the end of the year when this reality sets back in, okay? Now remember, those are forward-looking statements, and a million things could happen, right? We have gasoline that's down. Who knows? Gasoline could double between now and next month, and everything I said to you is kind of off the table. We're on top of it, but I'm just reporting the news as I see it today. Let's keep working here. Listen, I'm not going to jump into the bond relationship with yields. I talked to you guys about that before. I've shown you examples on previous webinars, so on and so forth. Hands down, one of the best bond buying opportunities for those who can hold bonds for 3 to 5 years that I've seen in my 22 years of doing this. Just a phenomenal bond buying opportunity. Again, if you're interested as to why, more than happy to unpack that for you. Always recommend staying focused on the fundamentals, okay? Bear markets seem like they're going to last forever. In other words, when markets are trending down, it seems like it's going to last forever. And when markets are going up, it seems like it's going to last forever. It doesn't happen that way. You've all seen this chart if you've been in a webinar in the past. Just to unpack it very quickly, this goes back to 1980. This looks at the S&P 500. The gray bars to the upside are showing you what the performance was every year from 1980, and this graph here is as of June 30th. My date on the bottom is wrong. I apologize. The red dots are showing you during any year what the lowest point was. In other words, just to unpack that for a second, let's use something simple. 1980, S&P 500 was up 26%. However, at one point during 1980, the market was down 17%. Last year, I showed you this. Last year, at one point in time, the market was down 25%. Yes, the market ended up down. The S&P was down nearly 19% there, okay, in 2022. This year, at one point, the market, in fact, was down 8%, right? But as I said to you earlier, right, as of June 30th, up, 16.9. As I sit in front of you today, 17.5 or whatever I showed you earlier. Point being is markets don't stay down long. Look at those gray bars. In fact, if you look at it, market up nearly 74, it's like 73 and change percent of the time. Even look at, years like we had in 08, 09. We had the market at one point down 50%. It was short-lived. It was down 1 year. Some people are quick to point out, hey, what about 2000, 2001, and 2022? Remember, this was the dot-com bubble. Look at that, 5 straight years of huge S&P returns, followed by 3 years of bad returns. But think about it, PE ratios, right? When we got into 2143, you all remember. You remember the dot-coms, right? That had no earnings, right? Some guy in his basement, that type of thing. So this was a little bit of a correction. But last year we had a down market. This year we're having a nice up market. And listen, I'm as scared as the next guy. I feel like things are a bit fragile because with this rise in interest rate environment, right, you get somewhat of a domino effect. My point being is they can now cut. And when they go to cut, the market's going to like that. It'll cause a tremendous amount of economic activity. Our labor market's extremely strong. Hey, Derek, what about artificial intelligence, right? We see, I showed you earlier, the tech sector of the market jamming. NVIDIA up like 170%, Facebook up like 150% for the year, right? Just to name a few. When you look at it, artificial intelligence getting a lot of buzz. I have clients in every sector of the market. I have questions about AI. I've been on the phone with some of these guys for hours. I want to get the inside scoop. What this chart goes to point out is there is a lot of fads, right? There is a lot of fads. I remember back in 06, China, that type of thing. There's the internet. Not saying AI is a bubble. This is FANG. By the way, for those of you who don't know what FANG is, it's Facebook, Amazon, Apple, Netflix, and Google. I can't really call it FANG anymore because Facebook's now called Meta. And Google is now called Alphabet, so I don't know what you'd call it. I think, this probably is not so much of a fad. Facebook, very monopolistic. They own Instagram, so on and so forth. Apple, obviously a bellwether at this point. Amazon, the world's largest consumer, staples and consumer discretionary above Walmart as, people buy stuff. Netflix, a lot of competition in that space, but their competition doesn't seem to be producing the type of content that Netflix is, but, competition from studios, so on and so forth. And Google obviously leading the way in search, constantly being fined. But I don't think that purple one is so much of a fad. AI, we'll see. AI, artificial intelligence, obviously things are getting better, but you look at NVIDIA making chips, they're the ones who are kind of leading the pack in this little thing, but AI is driving a lot of that. We use fundamentals. As I explained here, we look at things fundamentally. We want to buy companies with lower PE ratios that have a historic dividend payment and weather through, bad times and good times. It's always fun to jump inside of a fad and that type of thing. And listen, we do own some AI stuff, right? We do own some AI stuff, but it takes up small portions of the portfolio. I'm at the end here, so I'm just going to conclude with this. The market's doing great so far this year. 2022, it should have done great. There was no reason for it to sell off. It just did. It was predicting, things getting worse. We're now seeing that happen in 2023. When I say pay attention to fundamentals, you know how many people towards the end of 2022 wanted to sell? And they said, Derek, I just can't put good money after bad money. Look at things are down. Listen, we outperformed way better than the markets, right? Bond market was down 17, S&P down 20. Performance for our clients was much better than that. Wasn't like we were positive, but much better, beat the markets out. This year, right? This year, what should have really happened last year is kind of blowing its way in, right? Inflation's down, wage growth up, so on and so forth. But if we're going to go into recession, we're going to go into recession. It wasn't back in 22. It's forward. Fed's doing a really good job. Fed now has a parachute that they can pull. Labor market completely strong. That's the engine underneath everything. Listen, as I mentioned earlier, if we were doing this live, we'd open up for a little question and answer over dessert and coffee, but we're doing a webinar and it's always hard to do question and answer. And so if any of these topics you want unpacked for you, more than happy to dive into any one topic. If any of the topics that I said, hey, we got a whole webinar on what happened with the banking, we got a whole webinar on this, that, the other thing, contact us directly, email me, email your advisor, or whatever. You can reach us at Triumph, that's Triumph Capital Management, that's the website, Triumph Capital Management. What we do for our clients is we analyze the situation, your situation financially speaking. We help from that situation, give recommendations and show you how we manage money. Inside of there, we set realistic expectations as far as, hey, here's what's going to happen with the money, et cetera, and obviously ongoing communications and monitoring with all of that stuff. For those of you who may be on the call, look, it's the end of the day. It's almost 7 here. I get this weird thing coming through. You'd love our process. For those of you who are clients, thank you so much. We really do appreciate it, and we'd love to help you if you need some monitoring done. We're doing it internally all the time. You may not see that, but you want to get together, reach out to us. So listen, until next time, we wish you all a wonderful evening. I know this presentation kind of feels like maybe the last 3. It kind of has been, right? It kind of has been. It's monitoring inflation and wage growth. If you go back prior to this, totally different topics. Again, it boils down to our economy being as large as it is. It's tough to change topics every 3-6 months, right? So we'll probably be on this inflation wage growth thing for the next 6 to 9 months. And then it'll be, hey, unemployment's at 6, Fed's cutting rates, market's still doing well. We're on top of this stuff for you. We know you guys got jobs and practice in your own profession. So again, thank you so much. Loved everybody who was on the webinar tonight, and we look forward to speaking with all of you. Again, thank you. Hope you learned something, and I'm signing off. Thanks again. Bye-bye.